Good morning and welcome to the June 2025 update for the Spears & Associates Drilling and Production Outlook Report. I'm John Spears and I'll be your host for the next 60 minutes. I'm joined today by Richard Spears.
I am Richard Spears, and because we don't have a video feed, and today was the day that you and I chose to wear tuxedos. And I went to that expense of renting this powder blue tuxedo, and nobody can see it. Really disappointed by that.
Well, there you go.
But lightning storms.
There you go.
What are you going to do?
We're recording the podcast on June the 6th. I'm sorry. So that's the anniversary of D-Day. Although some of the younger members of our audience may confuse this with either Drive-In Movie Day, which is what it's also, or the National Donut Day.
That's a D.
And finally, National Yo-Yo Day. So there's all those things going on
after
here.
the famous cellist,
Yo-Yo Ma.
Yeah.
Or Yo Mama.
Yeah,
I forget.
you.
Anyway, we'll be getting into the forecast. And there's been a lot of news over the last 90 days since we last did this. And we want to use the session to sort through these headlines and look at the factors which we believe are driving CapEx decisions in the upstream sector. And then what that means for short-term and medium-term drilling and completion activity here in the US and around the world, as we measure it by rigs and wells and footage and so on. In the first part of the session, I'll go through the slide deck summarizing the state of the oil and gas market and our updated drilling and production forecast. And then after that, Richard and I will stand for questions. These can be sent in via the webinar chat box. I'll try and get these answered during the course of the session. I see that some have already come in that were sent directly to us via email, and our email address for those who'd like to follow up that way is sai@spearsresearch.com. One other piece of housekeeping, the slide deck and then the supporting PDF and Excel files have already been sent out to our DPO subscribers. Let us know if someone from your organization needs to be added to that distribution list, and we'll follow up. And then finally, feel free to link this webinar to social media, particularly LinkedIn, where it's being broadcast right now. The details of the forecast are for our paying customers, but the discussion is free and available to anyone linking on social media. So
I'll be giving a version of this, the land-related version of this, in Amsterdam next Wednesday at the World Congress for the IADC.
There you go.
So you could go over there.
Yeah, that's true.
And actually see what I'm wearing.
Or if you happen to be.
That's right. If you happen to be in Holland.
Yeah. So, Rich, before we get into the numbers, I was thinking that, what your thoughts are, sort of set up the context of where we see things going, because we've been doing this business a long time, and I think this is by now our 10th or 12th cycle of the industry. Right. And each one's different, and it seems to me that the key thing we all need to keep in mind as we deal with the fallout of $60 oil and so forth, is that going into this cycle, I have never seen operators in better financial condition than ever before. So balance sheets being relatively delevered, profitability being pretty high, and so I've got to think that colors how they would respond to this drop in prices that we've seen. What do you think?
If you look at the olden days of the oil and gas industry, which represented the first 50 years of our career in that, it was look out the window, tell me what the price of natural gas is. Yeah. Later it became tell me what the price of oil is. Right. And that will tell you what how much I'm going to be drilling and how desperate I'm going to be. But about starting in 2018, that's 7 years ago. Yeah. And fully in place by the end of 2019, going into COVID, the balance sheets were largely fixed, which meant we got debt reduced to about the right level for the operators. Yeah. We had the service companies, the weak ones were then eliminated. And you've got here since 21, 22, 23, 24, now 25. Yeah. Great balance sheets on the operator side worldwide. Yeah. You've got consolidation going on the service side, not great balance sheets. Right. But yeah, this is not the desperate times that you would see when, oh no, the price of oil's maybe $58 a barrel. Right. It's not that at all.
Yeah. Yeah, and again, the condition of the service industry is going to color their response when it comes to discussions around price discounts and so forth, don't you think?
Well, right, because in the last 5 years, quick, name me the number of new oil field service companies that have appeared. Hardly any. And it's because private equity disappeared, debt disappeared. So that meant that whoever was there in 2021, that's who's still there or is consolidating. So what creates great discounting in the oil and gas industry? A bunch of desperate new entrants who are discounting just to try to stay busy.
Low asset utilization.
That didn't happen. There's no sector that's got that kind of thing going on. And so you just got, you have these folks that have 30% of the market, and the next guy's got 25% of the market, and you go, we're not desperate.
Consolidation's a factor both for operators and service firms.
It is
something to think about as well. So anyway, with that said,
all right, let's
get into the numbers. I'll bring you back when we get to the end of my prepared remarks, and we'll answer the questions.
And
folks have.
I will bring you the questions that people have placed in all these various media.
Thank you, sir. Right. So, like I said, we want to get into the numbers, and of course, we're looking at demand and supply for the global oil market. This slide captures both of those things, and of course, the news that we've seen over the last 90 days has really affected both sets of graphs, right? The Liberation Day announcements and the sort of max tariff approach that the Trump administration has clearly rattled markets and made folks cautious when they think about future economic growth, and then that in turn has colored expectations with regard to global oil demand. So chart on the left looks at what those numbers are for 2025. I'm using numbers from the Energy Information Administration, EIA, on this particular chart. So about 1 million barrels a day growth in 2025, and slightly less than like 0.9 million barrels a day growth in 2026 by their lights, which is interesting because there are two other primary sources for demand forecasts. One is OPEC itself, which for both this year and next year is currently calling for 1.3 million barrels a day growth, and the International Energy Administration over in Paris is then the opposite side of that, 0.7 million barrels a day growth this year and next. So our friends in Washington at the EIA are halfway in between those two estimates. But an unusually large disagreement in terms of this near-term outlook for oil and gas demand. And frankly, with the outlook for economic activity and the impact of tariffs in such a state of flux, it's hard to say right now where things might go. But the point I would take from this is that other Asia, which is the gray part of the chart, and rest of world, which is the yellowish part of the chart, still and will going forward account for the vast majority of any growth we see in the marketplace. It's somewhere around 70% this year and 80% next year. And the point to be made there is that those numbers come in slowly, and it's fairly opaque as to the year-to-year change. So we may be there is a chance that those areas, lesser developed countries, end up being higher than what we expect. And I say that because we all know that that lower oil prices spur demand. And the rule of thumb is that for every 10% decrease in oil prices, you get about a 1% bump in oil demand. And so we've seen oil prices down about 15% year over year, it looks like. So you're thinking that we'll see a 1%, 1.5% increase in consumption just from a price standpoint, apart from the issue of trade flows. So there is that element that's supportive of oil demand growth. The other thing, too, is that oil's in most areas still priced in US dollars, and the expectation is that the dollar weakens relative to other currencies. So you have a price fall or decrease just associated with the strength of the US dollar. So there's a couple things out there in the marketplace that maybe would suggest that an OPEC forecast of demand 1.3 million barrels a day might end up being might be realized. We'll have to watch. On the right-hand side is the chart, again, that incorporates our estimate of OPEC Plus announcements that we've seen now 3 months running in terms of raising their production, both for the rest of for 2025, and then our expectation that they'll bring on the balance of these voluntary cuts in 2026. Now, we have simply added those barrels to the supply chart, which is why you see net increase in supply around 2 million barrels a day this year and higher than 2 million barrels a day next year. We don't know exactly how that's going to play out from the standpoint of will there be compensating cuts among other OPEC Plus nations, which might reduce the amount of increase this year and perhaps next. Is OPEC Plus fully capable of bringing on the barrels that they want to bring on? That's somewhat of an open question yet. So some of these barrels may end up being paper barrels, which the announcement is greater than what is actually affected in the marketplace. So we'll see. But one of the other things we've said is, okay, we're assuming that that these barrels all go into inventory as measured by the OECD, so the developed economies, Europe, North America, Japan, so forth. Now, these developed nations today account for about 45% of global oil consumption. So there's a lot of inventory being held in countries where we just don't have a very good fix as to what the level is and how fast it might be changing. So on this particular graph, I've said, okay, all those surplus barrels that don't find a home that OPEC Plus is bringing on will go into this inventory figure where we have some visibility. And that's probably not the case. Probably, I mean, if you would say maybe half of those surplus barrels end up going into inventory in areas where we're not counting what the storage numbers are. So the rise in inventories that you see through the end of next year, on the right-hand side of this graph, suggest may be higher than what we actually end up seeing. But I've sort of done this as what we think to be sort of a worst-case forecast for what the impact on inventories might be, because that's clearly how oil traders are going to look at it. They're going to monitor these numbers, look at inventories, look at what that means in terms of days of consumption, and try and make a guess as to whether the market's overstocked or not. Because really all that OPEC Plus is doing in terms of bringing barrels into the market is trading barrels that they've been holding in the ground for barrels that they would hold in storage. And so we have again some visibility on where things might go, and in other areas we have less. The point I would take is that where we stand today, here at almost the end of the second quarter in 2025, that inventories, as measured by this data series, are actually pretty low. So we've started off this process of reintroducing barrels from OPEC Plus in a situation where inventories are already under control. So I think that is one of the reasons why we've seen prices, which initially fell below 60, come back and are trading at 63 or 64 now for WTI. Just recognizing the fact that the inventory situation is in better control than, it starts off in being a pretty good place. So what does this mean in terms of crude oil production? That's the other thing we're looking at. So again, these are numbers from the EIA, which, as best we can tell from our own projections, match up pretty closely. So 1.6% increase in U.S. crude oil production this year, about 0.5% gain in 2026, with almost all the increase this year coming from the Permian, and because next year we expect to see decreases in areas outside the Permian growth rate will be twice the net increase in crude oil output. So we have that, I think, as a reasonable expectation for what's happening on the crude oil side here in the U.S. Natural gas liquids, again, count for the liquid volume numbers that we produce as a nation. They, of course, are drawn from the gas production, marketed gas volumes, and are extracted to gas processing plants. So they have a slightly different source to them, and different driver. They're not quite as directly linked to drilling activity as are the crude oil production numbers, because we're seeing gas volumes increase as pipeline capacity expands. And so gas volumes going up, more capability of extracting ethanes and propanes and things like that. So that's really what's driving the chart on the right-hand side, where we see then again about a 3% gain this year and a 3 to 3.5% gain next year as well. So the trends in the two numbers are different from those reasons. Gas liquid's much more attuned to both the gas production, the build out of gas infrastructure, and the demand for ethane in foreign nations. So natural gas then, what's going on there? So natural gas domestic consumption on the left-hand side split as we see it between power in green, industry in black, and then residential, commercial, everything else in blue. So it's pretty flat. Some growth in the marketplace, up just shy of 1% is the current forecast for this year. And you would see these numbers as being flat next year. That really incorporates a normal winter for the upcoming 25-26 winter. And that's always the variable. All the short-term forecasts assume that normal winter weather, and of course, we've had a somewhat stronger numbers in the past winter, and so that's why the blue part of the bar, residential, commercial, rose so much. The power sector growth continues thanks to data centers and the like, and crypto and whatnot, and is expected to grow somewhat accordingly going forward. But of course, the big swing year to year, at least this year and next, is what's the story in terms of net exports for gas. And so the red part of the bar are the LNG export numbers, and the blue part, or the black part of the bar, comes from what we export on a net basis by pipeline. So I always do net pipeline exports because we import gas from Canada, we export gas to Canada, and we export gas to Mexico. And I net those numbers out to show what's going on there from a pipeline standpoint. And there's a significant amount of growth going on this year and next in Mexico. And it's interesting because the story there is one of data center demand growth as well. So Amazon, Microsoft, and I think others have announced plans and have begun to put in data centers down in Mexico, and those will be powered by gas imported from the US. And so that's why we're seeing pipeline numbers growing over the next several years, as well as, of course, the well-told story about LNG export volumes going up as we add capacity. Have added capacity this year, we'll add some more next year, and of course, under the Trump administration, there's plans, build-out sanctions going on even as we speak about new capacity, new export terminals being approved for construction, and so that'll drive those numbers as well. So gas is looking pretty good. I think the thing that I would be paying attention to is the fact that when we look at the Permian Basin, the expectations, so in the past several years, the gas production from the Permian Basin has basically been grown at about 2x the rate of oil production growth in the Permian Basin. A lot of associated gas, wells get gassier as they get older, and so that explains some of the difference going on. Next year, Permian Basin, if the Permian Basin begins to flatten or go down, then the question becomes how fast will associated gas volumes from the Permian continue to increase. And so right now, there's if we see gas production from the Permian growing 2% or so next year, that's really the rate of growth that is being used for gas output from the Permian. So the discussion in the gas industry has been, how do you build all the infrastructure you need to supply the LNG forecast and the 20 to 30 BCF a day incremental demand on gas that everybody expects in the next 5 to 10 years. And I think as we get closer to the end of this year and into next, and we get a better handle on what's going to go on in terms of production out of the Permian, the discussion might shift. Instead of being where are we going to find all the infrastructure to handle this gas, it might be where's the supply coming from. And so I think the answer will drive a higher price for natural gas going forward. We've been fairly aggressive in our numbers, but I think there's a case to be made that we may be a little conservative on in terms of the gas side. So here's what we look like from a price assumptions for our drilling forecast. We're down about 15% from last year. We're at a $63, $64 average price for this year. We think prices will stay around in this 60 to 65 range over the next 12 to 18 months. So that being the case, then our numbers for 2026 are down another 3% from the average in 2025, since we started this year close to 70. So we've got that, to deal with. On the gas side, man, there's been quite the recovery when it comes to Henry Hub spot prices. They're on track to average somewhere close to $3.70 an MCF this year, and that'll be up about 75% from what it was last year. So we're on the up and up there, and again, we have a plus $4 price in our number for 2026, given where we think the supply-demand situation stands for gas. And I offer these wellhead numbers, and the break-even points, are an important part of the discussion as well. We think down the Permian Basin, if you just look at drilling costs, it's maybe a $30 price on average. There's quite a gray bar around that, what that average is. There will be some that don't break even at $45 on the drilling cost side. There'll be some who break even at $20. So you've got that. When we add in the operating costs on top of the drilling costs, you get an all-in break-even price in the Permian. On average, we think that's around $50 a barrel right now. So this north of $60 price leaves most of the operators in the Permian in the black. Although, again, there's a bell curve around what those average break-even prices are. And clearly there's some operators who are laying down rigs today because their break-even prices are a lot closer to $60. And this, they don't want to commit capital to projects that aren't going to make them money. Here's the other thing to think about before we get into the specifics of our rig numbers and so forth is cash flow from operations. And so we follow the publics. These are numbers from the international oil companies, so the Shells, Exxons, Totals, Equinors of the world. Going back to the first quarter of 2021 and through the end of our projections through the end of this year, based on this $62.50 oil price for the next 3 quarters. So, and what that basically shows is, of course, that the red part was where these companies were reducing debt retirements. That's largely behind us. We think it'll be de minimis going forward. Again, at the cash flow numbers we're looking at, it looks like these companies will be able to sustain most of the stock buybacks that they have enjoyed, or that their shareholders have enjoyed over the past year. We think that'll be a constant element going forward, and that their reinvestment rates will hold fairly steady at current levels over the balance this year. So on average, it looks like their CapEx will be somewhere around 48% of their free cash flow from operations. It was a little over around 55% last year. So not a real reduction in CapEx spending on the part of these international oil companies. And by the way, these are CapEx numbers for their global operations, not specific to the U.S. The U.S. oil companies, the ones that are publicly traded and primarily working in the U.S., so this is a much more U.S.-centric chart to think about. And it's again, the same set of numbers, all looking at how are operators choosing to disperse their free cash flow from operations. And here we think that on average, CapEx will be about 66% of this free cash flow number in 2025, down from 72% last year. Operators, these publicly traded operators, started Q1 with their CapEx numbers as a percent of cash flow were pretty steady from last year. We think that the absolute numbers for CapEx at these publicly traded companies, and very few of them, I mean, Diamondback was an exception in terms of announcing CapEx reductions. Most of the rest of them in their Q1 announcements and numbers didn't suggest a pullback in CapEx. I suspect we'll see more of that starting with their Q2 discussions. And so we're modeling that these publicly traded firms will begin to drop their capital spending numbers on the order of 3 to 4% per quarter going forward. So they end the year 6 to 8% lower than what they've been. They started the year in terms of capital out the door each quarter. But again, as best we can tell, their debt retirement and their stock buyback stories will probably stay, intact. Clearly, these firms are prioritizing balance sheet health and investor returns, and capital spending will be the swing element primarily be the swing element for most of these firms in the marketplace, we think. And then finally, the other thing about U.S. oil companies is, they have worked very hard in the last several years to control their capital costs and the spend that they do to drill and complete wells. The other thing that low oil prices are bringing to the front is focus on controlling their operating costs. And so what's interesting here is that this has been these numbers come in pretty steady quarter by quarter. With lower oil prices, there would be pressure as these operating cost numbers might trend up a little bit. We think operators will try and offset by lowering their operating costs. So the big spend items, there's not much they can do about power. There's something they probably can try and do about compression rental rates and some of the other operating costs that associated with keeping wells pumping and so forth. So I think that's going to be a more important part of the discussion among operators as this year unfolds. So all that discussion around cash flow and reinvestment rates and so forth. What does this mean, John, in terms of actual numbers? So as I'm sure you've seen, if you've looked through these the slide deck, or you've opened up our Excel files, we are looking at what we think will be about a 6% drop in average rig count in 2025 here in the U.S. So we were just a touch under 600 active rigs last year. We think we'll be at 561 this year on average, ending the year somewhere around 540 active rigs. And we think that next year will probably, on average, end up being close to where Q4 2025 ends up. So we've got close to a 540 active rig count for next year as well. Frac job count down a little bit more sharply. The operators have a certain amount of flexibility, with more flexibility on the frac side than they do on the rig side in terms of keeping crews or rigs out in the field. So we think they're bringing down frac jobs a little bit more sharply than rig count, suggesting to us anyway that the drilled but uncompleted number will build up somewhat, but not a huge amount. It's not like the kind of buildups we saw following the price collapse in late 2014, where the DUC count just skyrocketed. This will be a much more moderate number, again, because I think operators don't want to tie up capital in drilled wells, but wells that aren't on production yet. So they're going to try and kind of match both of those, the spuds and the frac job numbers, as closely as they can. But again, bringing down frac jobs a little bit more sharply than what you see on the drilling side. And again, we've talked about the production numbers already, so I won't go into a great detail. But basically, we're seeing that the Permian Basin ends up being the growth market on the oil side. That on the natural gas side of things, the Marcellus ends up in the blue part of the bar, ends up being pretty flat, constrained by their pipeline takeaway numbers. They're working on that. We're beginning to see some contracts being signed to supply gas to data centers that are in the Pennsylvania and in the Shenandoah Valley in Virginia. So there's some capacity for the Marcellus to increase production over the next 2-3 years. But the growth really comes from the Permian Basin, the gray part of the chart. And like I said, we'll have to monitor that closely, because I think that'll be key to a lot of the export numbers that people hope to enjoy, in 2030 and beyond. Other thing, of course, is we're modeling that drilling costs fall about 3% over the balance of this year. We do a quarterly cost survey, and pricing was up slightly in the first quarter, largely because we were catching a 17% increase in OCTG prices. Since then, I think there's a discussion around, even though we may have higher tariffs, the lower amount of drilling activity and what that means to pipe distributors in terms of trying to avoid a buildup in their inventories will be key. So one of the things we've tried to better understand is how much does the price of steel itself impact the final cost of OCTG. And so HRC is hot rolled coil. Beyond that, and that's maybe 30% of that final steel price for OCTG, or final pipe price for OCTG. Forming is another significant piece. You've got heat treat, you've got threading and coupling, you've got a bunch of other things. There's an element of margin in there as well. So the fact that tracking HRC prices is an element of the pipe price, but it's not a one-to-one correspondence, right? So you get maybe a third of that price increase in HRC or scrap metal prices as being reflected in the final price of OCTG. So that's, again, just something as we're trying to understand what this means, what the impact of tariffs, what the impact of domestic pricing for OCTG will do. But I think the key to understand is, in the inventory situation, because inventories, I think, for pipe will override any underlying movement in tariffs. We saw that in 2022 when the price of OCTG more than doubled, right? But the price of steel was relatively flat. But thanks to increasing demand in the oil patch, pipe got scarce and prices went up. That reversed in 2023. Pricing came down for pipe pretty sharply, and yet underlying steel costs didn't move that much. So again, just illustrates the all-important role that pipe inventories play in terms of setting pipe prices. And so we look at inventories, and one thing, last year imports of OCTG accounted for about 40% of shipments that we saw here in the U.S. This year, pipe imports have actually, over the first 5 months of the year, are up about 10%. Now, there was a big jump in January. I think a bunch of foreign suppliers tried to get ahead of any tariff numbers. Since then, the rate of imports has fallen. I see today that the numbers suggest that the April figures for steel imports in general were down about 20%. So we might expect that going forward that imports of casing and tubing will fall accordingly, and so that domestic share of market, which was 60% last year, could rise to, 70% and perhaps more this year, just because the import number we think is destined to soften as the year unfolds. And so again, now we get into what will domestic, as the pipe market concentrates, as more of it ends up in the hands of domestic pipe suppliers, which we know are pretty consolidated already. That suggests to me that to a certain degree, pipe pricing will, as the market consolidates, and discounting might be somewhat less than we would otherwise expect if we were to look at past cycles and compare past cycles. So, and I think too that domestic mills will be a little bit quicker to jump on and control changes in distributor inventory. So pricing on the pipe side has a lot of elements going on that are a little bit different this time in the cycle than others, and we'll just have to pay very close attention as we feel our way forward there. But we're not seeing a huge amount of pricing increase because of the pipe side, and any softening that is experienced in terms of rig rates or frac service costs, I think will offset any pipe or steel related increases, pipe price increases going forward. So we look at Canada. Canada, of course, as you can see in the chart, has been marching up and to the right very steadily until we get to this year. Lower oil prices are having an effect there. I think the gas part of the story in Canada is still intact. LNG Canada, the Shell export terminal, is starting up this month. And it's startling to see the impact that having LNG exports has on the futures market for gas prices in Canada. Canadian gas futures 12 months from now are 70% higher than the current price. And so no doubt that will continue to attract drilling with regard to developing gas reserves. But lower oil prices are going to really flatten out the Canadian numbers, we think, this year. We're just beginning to see it in the week-to-week, month-to-month numbers in Canada. And so we have activity down about 2%, 183 rigs, somewhere around 6,600 wells drilled all told. What'll be interesting to monitor going on in Canada as we have more, there's been a lot of M&A activity in the two shale plays up there. As we get new owners of those shales and they bring in Permian-like drilling and completion techniques, some of the early results suggest that you get about a 15% drop in drilling costs, $1 per MCF, dollar per barrel. So this application, if you will, of new and improved drilling techniques will, by lowering these drilling costs, may help to offset what we see going on the oil price side. And so our outlook for the Canadian numbers is a little bit more robust going forward than what we see on the oil side. So like I said, we've got aggregate numbers down about 2% this year versus a 6% drop in the rig numbers here in the U.S. International is the other part of the story we like to talk about. After having held steady in aggregate around 900 rigs running internationally the last couple of years, this year looks like it's coming down more like 873. A huge chunk of that drop, about half of it, is accounted for Mexico and the problems that Pemex is having in terms of paying its past due bills to the oil service sector. That's, I've heard, slowly getting cleared up, but it's being cleared up slower than we had expected. So we've taken a mark down our numbers for Mexico, and since Mexico is a fairly large chunk of the overall international numbers, our numbers for the year as a whole come down about 3%. You can see that on the right-hand chart, where in aggregate the rig count numbers in South America are down about 14% this year. Everybody else is sort of in the either +2 or 3%, down 4 or 5% range. So a little bit of tweaking going on in each of these areas. Point we would say is that at least for the international companies, their spend figures look pretty good. Again, the thing we always caution folks to remember is that internationally, in terms of project approvals, in terms of the most important factors, number one is the quality of rock or the quality of formation they've encountered. Number two is the fiscal terms that the host government provides. And only number three is the commodity price. So fiscal terms can be a make or break deal. In 10 years ago, Colombia saw 40, 50 rigs running, and it wasn't because they suddenly had a lot of great rock. It was because they made their fiscal terms for operators much more user-friendly, and that drew in a lot of capital. And so at a $60 price, we just don't see much alteration in planned activity for among our big international players. At any one given time, currently there's somewhere around 270, 280 projects in the pre-approval stage. 40 to 50 are getting approved each year. And we just don't see those numbers changing very much, even though oil prices have been dancing around 60. Because again, it's the long-term deck that they expect to see as really guiding. That's the important price. It's not the spot price for them. Onshore activity down about 2%. Again, I think all that onshore number is basically the net figure is due to Mexico. Offshore rig count numbers are also down, and again, the softening jackup market in Mexico is about the same. story there affecting the aggregate numbers. So we think that in 2026, next year, the international numbers will come in about at these same levels. Again, if oil prices hold in this 60-65 range. And then we break it down by region. So quickly you can see Central and South America down pretty sharply. Argentina is the growth story there, I guess. Expectations are if they can get the pipelines built, that oil production from the Vaca Muerta might double by the end of this decade. Down in Brazil, they've been increasing their offshore rigs under contract. That's expected to get to 30 or just above 30 by Petrobras by the end of this year. And then Petrobras, we hear, is going to hold at those numbers going forward. So some growth due to Petrobras down in Mexico that we'll enjoy this year, but beyond that, it's a pretty flat number as best we can understand it. Europe's up a little bit. There's been, Equinor is really the story driving Norway. That's where we see some growth. The UK is going through all kinds of turmoil up there, and I most recently saw a forecast that said that workforce in the UK sector of the North Sea may fall by 50% by the end of this decade, thanks to government policies to take away the fiscal support that our operators there need to develop these fields. So it's not a rock issue. It's not necessarily an oil price number. It's the fiscal policies that the government in the UK is pursuing. Africa's down about 5%. There's 10 or so field development projects which will probably see approved this year and next. So the story in Africa will highlight anyway some big deep water projects. The thing we have to remember about Africa is that that 95% or more of the activity, apart from Algeria and maybe some in Egypt, the rest of the continent is really all about oil, looking for oil and developing oil fields. There's a handful of deep water LNG export projects going forward. This is Africa remains primarily an oil development story. So they're constrained by what operators expect to see in terms of growth in oil demand on a global basis. And so, they've had some wonderful exploration numbers, but again, those discoveries getting turned into field development projects will be cautious at best. It won't be all in quickly. Finally, the Middle East up about 2%, we think, for the year as a whole. You've got several countries scaling up their LNG production capacities. Saudi Arabia is, we think, probably Aramco is going to have to rethink some of their capital spend numbers. I think their gas development projects will continue to be supported. We may see some softness in terms of what they're doing on the oil field rehabilitation side. We'll see how fast that story emerges. It's enlightening to explore rig count onshore in Saudi Arabia, because 70% of the rigs are drilling for gas right now. We always think of it as being a big oil province, don't we, Rich? But it's really onshore activity in Saudi, and to a large degree in Abu Dhabi is the same thing. It's a gas story.
Well, yeah, I mean, 2 years ago it's an oil province. Yeah, today it's a gas province.
Yeah. And then finally, Asia Pacific down about 4% this year. I think that's just sort of the chatter you get, when you begin to look at year-to-year numbers. Projects start up, projects wind down, exploration programs start up. I don't think this is really indicative of a turning in the marketplace. I think it's just the usual chatter. Indonesia's been they've had a change in presidential administration, and that has, not surprisingly, had an effect in terms of the outlook and the enthusiasm that operators have for investing in their upstream industry. And so I think that's going to see activity and projects in Indonesia pick up as well. But so that's the end of my prepared remarks. Rich, I would like to lead with a question. We've talked about Saudi and how activity might be changing, but you have some thoughts about what that really means for contracting in the oil service sector, right?
Well, because as people are sometimes surprised, if you crawl inside Spears and Associates offices after hours, you break in, and you look at who our clients are, you find that two of our largest clients are Saudi Aramco and ADNOC. And where's their headquarters? Well, it's Saudi Arabia and it's the UAE, and they have retained us for years, not for our help in the Middle East, but for our help in the United States, helping them understand how does a robust, independent oilfield service industry behave.
Right.
And you've seen those two countries
where shale development or unconventional is the driving factor.
You've got land related. I got to drill a bunch of wells.
Yeah.
And you've seen them, especially over the last 5 years, move strongly to adopt that model.
Yeah.
And so as a result, the role of Schlumberger, Halliburton, Baker Hughes will always be there for the big, exotic, high value, high quality, offshore challenging wells. But for the shale related stuff, where I'm going to drill 100 of them, independent service
which
company.
means that Aramco is no longer buying stuff so much as they're doing what we do here in the U.S., where, like you said, bits are being rented as opposed to sold, right?
Yeah, that's a very good example. Whereas a year ago, if you're a drill bit provider, you sold it to Saudi Aramco, and a year from now, you'll be renting your bit to Saudi Aramco. It changes who has the ownership of the bit.
Sure.
From the oil company now to the service company. It changes the capital structure a lot.
Right. And so income now is not, so the driver looks different, right? And so that may be more important than the fact that oil is 60 as opposed to 65 or whatnot. There's those kind of commercial concerns in the marketplace, which are playing out as well as we see it in Saudi, and probably Abu Dhabi's got the same momentum there.
So in the last 11 minutes of the broadcast here, there was there's a great question just came in. Timeline expectation for Mexico to recover.
I think the answer is mañana.
That's actually probably the correct answer.
The Pemex has got a problem, right? Because what they're selling their oil for is lower today than yesterday. So the revenue that they're enjoying and their free cash flow, they're the most indebted company in the world, I think, right? So they don't have capacity to go to banks and help me out with my cash flow problems, that kind of thing. So this is really a constraint when it comes to them. And I think it's forcing them to prioritize, do we do what we always like to do the most, which is shallow water oil field, production? Do we, what do we have to cut in order to, bring this all back? Or do we try and bring it all back at the same time very slowly, right? So I think the answer is that they're trying to bring it all back sort of at the same time, because they cut onshore and offshore, but it's a slow go. So I would, at this point, I think you have to get into the next fiscal year before you're really, where
do you have to get into the next president?
No, because she's got another 4.5 years to run, I think.
Okay, so different fiscal year then. All right, a question we got a while ago. I don't know if you answered it as you talked today, but how do these global supply-demand numbers take Iran into account? And if there's a new, I'm going to be George Bush here, nuclear agreement,
right?
To what extent does that impact next year's drilling forecast?
So and you get stories on both sides, right? We're working for an agreement. No, we're not going to talk to each other. And we may go max sanctions on Iran, like under Trump 1 was the case, which would take, probably, you got to allow for cheating and everything, but it'd take maybe 500,000 to 1 million barrels a day off the market. So you've got that as an option, right? You can get, I don't think if an agreement were to come into place that Iran could do much in terms of lifting its output, right, at this stage. So, because the Chinese are getting a lot of it today and so forth. So, I think the only variability in the story about Iran is do you take their oil out of the market, and if that were the case, even after OPEC Plus brings us 2.2 million barrels a day oil into marketplace, they'll still have they'll still be holding off the market close to 3.5 million barrels a day. So anything that might happen on the Iran story that takes Iranian exports off the market, or a chunk of them off the market, the rest of OPEC could meet, and so
at least temporarily.
Yes, right. So Yeah, so I just don't, the whole thing about Iran will drive a lot of headlines, but I don't know it's going to be, much of an impact on where we see oil prices going.
Our friend Amy sends a question about oil field service company capital discipline, because all the stories about oil company, E&P capital discipline, and is the OFS capital discipline continuing, especially with regard to the building of new capacity? And, my short answer is OFS capital discipline is still fully in place because you have to have capital discipline. Yeah. You can't outspend cash flow. I sit on I don't know how many boards of oil field service companies, and all of them are profitable. All of them are cash flow positive, but it's not like we can go down to the Bank of Oklahoma or the Bank of Texas and go, get anything more than our existing line of credit. Yeah. So just debt. Like one of our companies tapped into the Norwegian bond market, and that was great. But is it still fully there? Don't know.
So it's maintenance capital, not growth capital. And we don't see any new entrants coming in. That's the other thing, right? That's driven a huge chunk of capacity adds on the service sector in the past decade. But there's just none of that going on, right?
Yeah, and it's really modest growth capital. What you can sort of do is get a little bit of debt, and I'm talking modest amounts. For an acquisition. So you find somebody that's going to be a great fit. It's going to be immediately accretive. Most of the purchase price has to be either the shares you currently own that you're going to swap with them, cash you currently own and you're going to give them, or you can go to your beloved lender and get maybe 1x of EBITDA. But no more than that.
Yeah. So that touches on something I think is important. As we see it going forward, there's clearly going to be further consolidation among the big oil companies, right? The big guys are going to look to acquire inventory by others, and so the consolidation story, which has been happening on the oil operator side, will continue, and this consolidation among oil service firms, I think, will follow. But that won't add capacity to the marketplace. That just puts the capacity in fewer hands, right?
So can I tell you, here, by the way, are the 8 sectors in our oil field service, oil field market report. These are the 8 sectors, market segments, that are the most consolidated.
Ooh,
how about this?
Okay.
Ready? Trees, capital equipment.
Is this in order?
No, it's just like
most
it's the most consolidated.
Yeah, gotcha.
2 or 3 have at least half the market, and generally 60%.
Yeah.
So surface and subsea trees.
Yeah.
The capital equipment space. This is the NOV world, if you will. Land drilling.
Ooh.
Because you can't. You add up
H&P,
neighbors,
P10,
and ADNOC.
Oh, so you're talking from a global standpoint.
From a global point of view.
Gotcha. But North America is the same way, right?
It is, because
H&P is 25% of the rigs, right? So
even though there's still 35 frac service companies, frac is highly consolidated now.
Yeah.
The drilling fluids company, like 2, represent half the market.
Yeah, sure.
And weirdly, even though North American land directional drillers, there's bunches of them. That's a very consolidated space once you leave North America. And then your favorite, the thing that keeps you busy, compression.
Oh gosh, yeah.
Very consolidated, and cementing.
Compression rental,
Compression rental.
Yeah.
And then cementing, and those are the consolidated, highly consolidated areas.
So a greater degree of consolidation concentration than we've ever seen in the upstream sector before, right?
Since probably 1999.
Right, yeah. So the story would be, you would think that price discipline, would be not just capital discipline now, but pricing discipline would be perhaps as important to those guys as, or more important than we usually see, right?
I do not have desperate new entrants who have a boatload of debt, and they're just trying to keep their trucks busy. Or their rigs busy, because it's like there's no new entrant.
The banker would.
That's right. Right. We're just going to try to make the interest payment. Yeah. Largely, the debt issue for most companies has been largely resolved, even on the service side.
I think the other part of the story that I've heard you say is that the drilling programs now are so finely tuned that it makes operators, and completion too, that they don't want to, like, well, your price is too high, we're going to throw you out and bring in another guy. whose track record, they just don't, maybe know what their track record is as well, right? And God forbid we run into flat space on the schedule because somebody new has going on, right?
Yeah.
So that track records, performance records are very important part of the discussion.
Hey, we got a great question just came in, and it's, what do we expect to see going forward in terms of the average well depth and the average number of clusters or frac stage count per well? And is there any significant trends in things like simul-frac, trimul-frac, or the horseshoe thing that's going on? And the answer to all those things is pretty much yes. Average depths, and by average depths, I'm going to say average length of hole, measured depth of the well, gets longer by a lot every year. Average length of hole last year was like 10,500 feet for the lateral, and this coming year will be 11,000 feet, and so it just gets longer and longer and longer. And the frac stage count thing, like how closely do you put frac stages these days? And you don't see them 500 feet apart anymore, but you see a bunch that are 150 feet apart and a bunch of frac stages. But also, there is no doubt that so much effort is being put into the completion process. And can I simul-frac it? Can I trimul-frac it? Can I quadra-phenia track it? Can I drill a horseshoe? It's becoming more and more common.
So, I think one of the other things that argues against a lot of discounting in the marketplace is that operators, $60 oil, right? They were thinking it was going to be 70 to 60. They've turned their engineers loose in terms of redesigning the well bore and how we're going to drill it, how we're going to complete the well and so forth, right? To look for ways that they might be able to save money. Can they use liner hangers and production strings and not run it all the way up to the surface, things like that? Can they use a 6-inch, production string instead of 5.5, because it saves them something on the completion side. So I think a lot of that's going on, and I'm sure operators will be able to find, things that they can do. And the great news with that approach, at least in my mind, is that once they come up with a new and improved, drilling completion program, they can apply it to all their wells. They don't have to take the time to renegotiate. I want a 10% discount on your unit price with 20 or so, or whoever knows how many suppliers they have in their supply chain. They can do a redesign and say to all of them now at the same time, here's what we're going to be doing. It's different from what we had. It's going to save us, 10% on the cost of a well.
Bring out 2 fewer frac pumps.
Yeah, there you go. So I think there's a lot of that going on. So it's not just a story about discounting. It's also going to be a story about where there can be cost savings that they realize.
John, to close out, because it's 10 o'clock now, our clients and everybody in the world will see that at the end of June, we're going to relaunch our website. And with it, we'll have new services that can be subscribed to by individuals. And the primary one that's going to be very interesting is called Drill Source. And Drill Source is U.S. land. Our objective is to take every operator in every basin in the United States and identify the number of wells they're going to drill this year in those basins, right? And who their primary contractors are in land contract drilling, directional drilling, cementing, hydraulic fracturing. I hope we can do it for drilling fluids. There may be another. Did I say frac? And the amount of money, for example, that Diamondback will spend in the Midland portion of the Permian Basin on hydraulic fracturing services from ProFrac. It'll be that specific for the year. And we've shown it to many, many people. We've fixed the problems we've had over the years, and that thing goes live.
The consolidation among operators has clearly asked a lot of questions about what does that mean to their supply chains. Who are the winners and losers, right?
So it's about, the accuracy will be about 80% right. Nothing's 100% right in this exercise, but it's pretty right. And that'll be available to, again, the first 1,000 subscribers, because it'll be individuals, not corporations who subscribe to it. And it'll be $100 a year. It'll be the cheapest thing we've ever done.
Will be more to come in terms of hearing us about that. Thank you for listening to us for the past hour. And like I said, we've answered a bunch of questions. If you have more, feel free to email either Richard or myself. and we'll get back to you as soon as we can. And in the meantime, we're all looking forward to the first Friday in September as being the next time.
All right, I'll try to be here for that. Thank you, John.
Thank you. Take care.